Hi, everyone. This is Ira Coiner, President and founder of Triathlon Partners. Thank you very much for tuning into Triathlon's TV episode about estate planning, episode 2. Uh, Thank you very much once again. We really appreciate the support we're getting. Please leave comments and thumbs up below on in the YouTube. We greatly appreciate that. Now, where we left off in the last episode is how we construct things in and out of your estate. But most importantly, we didn't actually say what we did and what we're supposed to do to maximize that. Now, when you put things out of your estate, they go into an irrevocable trust, right? There's very limited changes that can go on, but when we move assets in there, those are not subject to estate taxes, right? And what we actually try to do is when we move things around between what we keep in your estate and what we move out, it's really largely up to tax considerations, right? So we have three different asset types we're going to talk about. We're going to talk about income generating asset types. We're going to, because they're taxed as ordinary income, we're going to talk about appreciating assets, which are taxed at long-term capital gains rates, right? And then we're also going to talk about life insurance, right? Because life insurance is not subject to income tax or capital gains tax, right? So what we want to talk about is income, that the generated income is you pay at your earned income tax bracket, marginal tax bracket. If you're over $400,000 for a couple or $200,000 for a single person, you're talking about 32%, right? And you got your state taxes on it, on top of that, et cetera. But when that's in your estate or out of your estate, it's taxed at the same rate, and it's taxed annually when the interest is paid, when the bond coupon comes in, et cetera, right? So you gotta know that because it doesn't matter where it sits, right? So what really we're focusing on is that limit in your estate, right? So number two, we have these appreciating assets like stock, right? So a lot of stocks that have gone up over the last 10 or 15, 20 years, Microsoft, Apple, Berkshire Hathaway, names you guys know, you probably own them, right? Now, when they sit in your estate and you're alive, if you decided to sell them, you're going to get taxed at long-term capital gains rate, which is 15 or 20%, depends on what your total income is. And there's a surcharge for Medicare that's 3.8%, right? So if we'll round to 4, you're talking 19 or 24%, right? Less than your income tax. But when you are alive, you're taxed on the profit that you make. And that profit is from the basis, and the basis is where you bought it, to the selling price. You subtract it. That's the profit, multiplied times the capital gains tax rate. That's your taxes, right? That's your taxes when it sits outside of your estate, right? But when you die, it's treated differently in your estate. When you die, your beneficiaries get that stock, but they don't get it at where you bought it for tax purposes. For tax purposes, they bought it at the price or value it was trading at on the day you died. So if you were going to pay a lot of capital gains tax now on something that you were going to sell, the day you drop dead, your beneficiaries can sell it and not pay any taxes, right? That's a big windfall in the tax game in the amount of money that you can pass off to your beneficiaries. If that money was sitting outside of your estate, there's no difference whether you are alive or you have dropped dead. It's taxed the same way, right? Very important because we want to make sure we're maximizing what we can keep of that wealth. And if we're paying less taxes, that's very important, right? Another asset that we have is life insurance. Now, whether it's term, whether it's whole or universal life, it has cash value. Still very important to realize that when you die and you have life insurance, that death benefit pays off. And it pays off And that basis question that we have with the appreciating assets doesn't exist with life insurance. There is no basis. That money is not taxed on income or capital gains. It is subject to estate tax when it's in your estate. And many people don't have $100,000 of life insurance. They could have millions of dollars in life insurance. So you can very quickly keep it in your estate, not realize it's there because you just look at your brokerage statements or your house value on Zillow, and you sort of look at, oh, wow, you just rocketed through that top bracket. You're going to pay a lot of taxes. Now, something that when it's outside of your estate, there's not that basis question again. There's no income tax. There's no capital gains tax. You keep it outside of your estate. And then all that money that comes in from the death benefit isn't taxed, isn't subject to estate tax. And you're able to have things in your estate that are going to be maximized when they're passed on to your beneficiaries, right? So those are appreciated assets versus income and life insurance, which you want outside of your estate normally, right? Now, again, you should always be consulting with an estate attorney as well as CPA is very helpful, and also your financial advisor, because your financial advisor, we know your objectives, we know your goals, so we're in the best situation to make sure that who you want to take care of and how you want to take care of them is done properly, right? And it done in an efficient way, as well as that we spend these assets down properly over time, right? So thank you once again for tuning in Triathlon TV, episode 2 of estate planning. I hope this was very, very educational for you because our firm, our values are about engaging, educating, and empowering our clients so they have the knowledge to make a confident decision that best meets their objectives. Well, thank you very much for tuning in. Please, if you thought this episode was very helpful, give us some thumbs up, leave some positive comments, check out our website, give us a call. This is Ira Coiner once again. Thank you very much. Have a lovely, wonderful, and blessed day. Take care.